holding all right around that 25,300 mark. So let's welcome on board Seshadri Sen, the Head of Research and Strategist at Emkay Global Financial Services, joining us. Hi, Mr. Sen. Good to be speaking with you. Well, I'm just going through your latest note, and it seems like you have raised your target for the Nifty all the way to 26,000 now for September 25. Earlier, it was close to 22,000 for June 25. Is it just the market momentum that has made you change it because we are very close to that mark already? Or do you see a further uptick in the fundamentals versus what you anticipated earlier?
Hi, thanks for hosting me on the show. No, the primary driver is that there was a few speed bumps that we were anticipating in the first half, and those played out. The market though blew through those speed bumps quite strongly. But we're looking at a much smoother ride in the second half in terms of fundamentals, which is why we raised our multiple, and that cascaded into a raised Nifty target. We don't see any major upheaval in either direction, negative or positive, in the second half. Earnings are probably the most stable we've seen in the last 2 or 3 years. Upgrades and downgrades are not moving significantly, upwards or downwards. We have valuations are a little elevated, but if you look at, say, India's macro financial stability, that does warrant a somewhat premium valuation. So all these combined, we raised our target price, and our view is that the market will continue to move sideways for the next in the foreseeable future, and with some level of sector rotation. I don't see a significant downside risk, but upside is a little limited given the valuations.
Okay. So what I can see here is you have increased the valuation multiple to 22 times from 19 times. Or what is the kind of earnings growth that you're expecting over the next 1 year, and which sectors will be contributing the most to it?
Yeah, so we are looking at Nifty earnings at about 15% for 12% for FY25, and around 15 for FY26. That's the consensus number, and we think that the market, will broadly deliver in line with that consensus. This time it's a little more evenly distributed, with industrials, durables being very strong sectors in terms of earnings growth. Those are the two main areas where we see some momentum in earnings.
So energy as a sector to overweight, what is the rationale behind this?
So we are looking at oil prices remaining relatively benign, the commodity basket remaining relatively benign. As you know, a lot in the Indian energy sector is largely exposed largely benefits from softer crude. Yes, for some of them, earnings is slowing down in FY25 versus 26, but valuations are still not very worrisome, and therefore we raised our energy weight on the back of expectations that crude will remain in the range bound over the foreseeable future.
You're underweight on the financial space, but don't you think that if there is a rate cut in the next 2-3 months, that would benefit the sector?
No, actually not. We've been underweight structurally on financials for quite some time, almost a year now. And our view is that, first of all, let's get the rate cut argument out of the way. Yes, it will help their deposit growth. We've argued in the note that the current deposit slowdown is entirely due to macro tightening, nothing to do with allocations to capital markets. And that deposit growth will start to recover once the rate cuts start and the RBI starts their easing cycle. But that is a relatively minor positive compared to the big negative that NIMs will start to come under pressure as mortgage reprices, because most of the larger banks are 25 to 30% exposed to mortgages. Those are in turn linked to repo rates. As soon as repo rates get cut, they take it on the chin. It takes at least 3-4 quarters to recover that from lower cost of funds. So that's the immediate cyclical threat to the financial sector. Structurally as well, we believe financials is in a low growth environment compared to history, and the downward valuation adjustment is not complete. We would be happy if we think that the fair value of private sector financials is somewhere in the 1.5 to 1.7 range. None of them are trading there, and this sort of time correction and continued underperformance is not about to end.
Seshadri, what's your view on large cap versus the broader market kind of conundrum? Because yes, valuations, etc., have been quite frothy in the broader markets, but they continue to move higher. Do you think it's time for large caps to catch up, as has been the case in the last few months, or one should have a very balanced view and split between the both?
If you take a 2 to 3 year view, we continue to believe that small and mid caps will outperform because the earnings momentum is coming from sectors such as industrials and consumer durables, which are primarily populated by small and mid cap companies. The only thing one has to be a little careful about is that many of these small and mid cap companies are trading at very frothy valuations, but it's a large universe. You could still find a lot of relative value in the small and mid cap space, and I do believe from a 2 to 3 year perspective, they will outperform. In the shorter term, while the market is moving sideways in the next 1 or 2 quarters, then you could see a more distributed performance. But being totally invested in large caps is, I think, a little risky because I don't think there is an argument that they will structurally outperform the small and mid cap. So you need to have a mix, and in the short term, maybe a little more biased towards large cap. But for 2 to 3 year perspective, we continue to be bullish on the small and mid cap space.
So that's the view coming in on large cap versus small cap. What's the view on consumption? Because at a time when people are bullish on rural recovery, one would have imagined that you would be positive on staples, but it seems like that you are a bit on the back foot when it comes to consumption. Help us understand your thesis there.
So we are actually bullish on consumption. Our note says that we think that the rural recovery is here and it will continue for quite some time. And not just rural, mass consumption across both rural and urban. We are expecting it to recover in FY25. Having said that, some of this has played out. We upgraded consumption a few months ago, but now they're all trading at relatively elevated valuations. The issue is that with these FMCG stocks, the underlying earnings growth is relatively tepid, even in a bull case. Bear case is 5 or bull case is 8-9%. So if you have to, the stock price movement depends on the valuation moving. And once the stocks trade up to +1 standard deviation of historical range, upside on valuations get limited, which is why we've downgraded it to a neutral. We think that there are maybe smaller cap ideas, value retail, some of which we don't cover, so we can't name names, but those are probably where you can see relative value. But the staples is probably not the best way to play rural recovery because it's already played out in the recent last 2-3 month rally.
Thank you, Mr. Sen, for joining us and giving us that perspective that you have on market.
Thank you for hosting me.